the investment world, there's many different ways you can invest your money. One would be stocks. You buy a small piece of a company, and if the company does well, your piece is worth a little bit more. Maybe it even pays a dividend. Then there's bonds. You, along with others, pull your money together to loan out to companies, and they pay you a fixed rate over a long period of time. Definitely considered more stable than stocks, but with much smaller return as well due to its safety. Of course, there's gold, commodities such as oil, mutual funds, and many others, but today we're going to be talking about real estate. Real estate is viewed as a middle-of-the-road type of investment to park your money. It does fairly well, on average better than bonds, and it's relatively safer than stocks. However, most newer investors are unfamiliar with actually how to start investing in real estate. Hopefully by the end of this video, you'll have a good idea of where to start. Initially, there's 4 factors or questions you need to ask yourself as an investor. These topics are in regards to capital or money, goal, type, and location. After we briefly discuss those, I'm going to show you an extremely simplified way to make a quick snapshot judgment of a property. The first and foremost thing needed to start investing in real estate is money. Practically every property type requires a buyer to put down between 25 and 40%. In fact, there are going to be times where you may not even be able to get financing. For instance, if you're looking into buying a $2 million office complex that's fully leased and producing stable income, you will need a sizable 30 to 35% down payment. But if the same $2 million property is an apartment, you may be able to get away with 20 or 30% down payment. But if the building is empty or only produces a very small income, then you're likely going to have to pay for it all cash. This is because the income that the property generates must pay for all the expenses, including the mortgage, and then some, as discussed in my commercial loan process video. This is one of the primary reasons many individuals don't take the time to learn how to invest in commercial real estate. It requires so much capital. The plus side is that real estate is considered to be a much more stable investment vehicle. The second question you must answer as an investor is, what are my ultimate long-term goals? Of course, your likely answer is going to be to make more money, but you need to be more detailed than that. So how? Do you want to hold all your property forever and only base your decisions on rental income? Do you plan on buying properties that are distressed only to lease them up and flip them for a higher price, as I've talked about in my value add properties video? These are just a few of the decisions you really need to answer before you start buying. The final factors you have to address are what property type you plan on investing in and what locations you're willing to go. There are all types of property classes in commercial real estate. Everything from apartments to office complexes to retail and industrial, along with multiple different subtypes, one among them being land. Apartments at the moment are a good bet due to the housing issue and can easily be financed, but they can be extremely management intensive. I actually go over the apartments a little bit more in my Why Apartment Market is So Hot Right Now video. Whereas a retail center might generate a little bit higher return with very little oversight. But what if your large tenants file bankruptcy and goes dark? In regards to location, most novice investors prefer to stay local since they know their area. But your local market, wherever it may not be as stable as one of the large markets, such as the San Francisco Bay Area, Greater Los Angeles, New York, and so forth. A market with only one type of primary export or employment type, such as mining or agriculture, will not be considered as stable as a market that has a diversified employment type, which may include electronic exports, banking, construction, and healthcare. Now that we've touched a bit on the important factors you need to address, let's discuss how you could start to look at properties differently. When you buy a home, you're usually buying it for its comfort, its feel, its neighborhood, the proximity to schools, and so forth, right? Well, let's say you've grown out of that same home. You need a larger one for your family or maybe have to relocate for work. Presuming you have the funds for a new home regardless, should you keep a home as an investment or sell it and buy something else? I was asked this very same question by a client of mine recently, and I'll tell you exactly what I told them. It depends. Yes, I know you just want the short answer, right? Well, first, let me explain the scenario. I had a client who bought a new home because they needed more space. They had their old home for years. The property was worth about $300,000, but they didn't owe very much on it, and the mortgage on the place was about $1,500 a month. They could easily rent out the home for $1,800 once they fully moved, but they were arguing about whether to rent it or sell it completely and reinvest it somewhere else. First, what do you think? You own a home you no longer live in worth $300,000, and you could easily rent it for $1,800, which would cover the $1,500 mortgage. Do you rent it or do you sell it? Me personally, I'd sell it in a heartbeat. Now, maybe this might shock you. Why would I sell it when I could easily make $300 a month? Well, what if I told you I could make $600 a month, maybe even $1,000 a month? Here's the general rule of thumb I tell my clients, and please note, this is a very, very general rule of thumb. Do not, and I repeat, do not use this as an investment formula to pick an investment. This general rule of thumb is that for every $100,000 that you spend, be it on purchase price or a mix of purchase price and repairs, you should make about $1,000 a month. So if you buy a home for $150,000 and it needs 50 grand in repairs, you should be getting around $2,000 a month for it. Make sense? Now, a little disclaimer besides to not use this as a formula to pick an investment. The type of property and the location, along with other factors, will sway this. In an area like San Francisco, most investors are happy making $500 a month for every $100,000 they spend. If you're out in Texas, investors might want $1,200. Generally, the larger metro areas will accept less than $1,000 a month, whereas rough neighborhoods, poor quality properties, and so forth will demand more. So now let's apply this to my client scenario. First, the whole concept of the mortgage in our snapshot formula is completely irrelevant. If they have a $300,000 property, they should be making about $3,000 a month on it. To apply it directly to them, because of their area, they should have been able to make about $2,700 a month. To me, by them not selling the property, they were cheating themselves out of a good $900 more a month. Of course, one of them did bring up a very important topic. What about the property's appreciation value? If you have to sell the property in order to ever see a nickel of appreciation, why didn't you sell it back in 2007 or so? In fact, how many people can you think of that didn't sell and they're now wishing they had? I'm not saying that you should never figure appreciation, but let's face facts. This is an investment. Unless you're skilled enough to know a property's value is going to skyrocket, and the complete opposite has happened in the last 3 to 4 years, why would you base such a huge chunk of your decision on that? Especially when the whole time you can sit back and collect income every single month versus in some time in the future when properties go up at some random pace that nobody could possibly determine. Personally, I'll take my monthly income anytime. After I was able to show them a property or two and provide them with charts to back up my claim, their property was sold and they're currently making $1,100 more than what they thought they were going to make with the same amount of money from the proceeds of the sale. Investing isn't something you should just ever jump into. Regardless if you're considering stocks, bonds, or real estate, you should always educate yourself as much as possible to make an intelligent and informed decision. After all, we're talking about your money. The problem is most people never take the time to do so. I mean, with work, family, life in general, it's completely understandable. The good thing is that there are people in each field who would gladly help out and answer any questions you may have. It's your responsibility to seek it out. Now that's good to know.